Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So over the last week the market has been very volatile, and the reason is because there were so many earnings reports coming out. If you own the ETFs that tracks some sort of the big boys, if you like, the magnificent seven, some of them anyway, like Microsoft and Meta and so on, they've done absolutely amazing job, and when you look at their earnings report was really good. But if you own everything else and you've got diversified portfolio of stocks, then of course you felt exactly the same way that I felt, because my entire portfolio was down almost £4,000 for just last week. And but earnings reports are, they do these things, which is one of the times, that I actually buy more stocks. Gives us an opportunity for us to add to high quality businesses that have reported really good earnings reports, but somehow Wall Street does not like, and they start selling it, and everyone start following it, following whatever they're doing, and then all of a sudden the stock is down 10-15%, which is nice. I mean, literally, if there's nothing wrong with the business, it is good for us because that gives us an opportunity, like I said. So if you look at the S&P 500 last week, you would notice that basically that it was down like. So if we just click basically the 5 days, what you will see here is the S&P 500 was down 2.5%. The Dow Jones was slightly up. The Nasdaq was down 2.5 as well, and the FTSE 100 was down 0.5. So when you look at the 1 week, things have not been great. But when you look at the for a year to date, that's when you realize, okay, we're not actually doing bad at all. 6%, and on the S&P 500. If the year closes right now, that you'll be happy with that. Of course, the 7, 8, 10% will be better, but at least we are up. We're not a down year. You know what I mean? So it is good that a lot of these indices are doing a great job so far. But at the same time, when you see a pullback, just like what we've seen last week. So this is the S&P 500 plus more. That basically just the heat map for just the last week. And there are companies, for example, if I show you here, Apple, for example, is just down 5%. But look at the Alto Networks, for example, about 15% down. Amazon was down about 7%. You think companies like Qualcomm was down about 7% because they reported. Companies like ARM was down about 16%, which is absolutely crazy. But the craziest one of all is this one here, Novo Nordisk. This is down 33%. So it will be interesting to see what the rest of the companies that are similar to Novo actually will say the next week, because we've got Hims and Hers actually reporting. We also have Eli Lilly reporting, so we'll see what they say as well. But yeah, there is a lot of other companies that are reporting. Uber is one that I'm actually looking at. Just I'm planning to do a video, inshallah, once they report. We've got AMD. We've got companies like Applavin, for example, that's actually reporting. Another one is Fortinet. So there's quite a few companies that are still reporting, but the big boys, the magnificent seven, have now reported, all of them, and they are make huge because they are the biggest when it comes to holding side of things. They are the biggest in there. By the way, also Palantir is reporting, although I don't own it. I don't think even Shariah-compliant anymore. But yeah, so there's the big boys have reported, but let's see what happens to the overall market. So what I'm going to do today is share with you guys 5 companies that are still undervalued despite all of this basically madness that's been happening. All of these 5 companies seem undervalued at this point in time. Before we get to the video, I just want to basically ask everyone just to stop and press that like button if you have not subscribed to the channel and you are regularly watching these videos. Then what you waiting for? And I think there's about quite a lot of you, about over 50%, like 40% of you guys that watch the videos regularly are not subscribed to the channel. So please do like the video, subscribe to the channel, share with your family and friends, and if you can join us the Patreon account, it makes a huge difference too as well. And keep sending me sending to me your subscriber portfolio reviews. Inshallah, I will get to them as soon as I can. Now, one of the things I want to explain is that I've got a question about this part here, what Morningstar valuation. So Morningstar will tell you. So let's look at the first company and then we'll take from there. And the first company, there's no surprise because these are high growth companies. And when we talk about high growth, we're talking about, for example, things like the revenue side of things, the things like the EPS, massive growth over the last 5 years, and they are expecting to grow decently next couple of years. Now, It says here 30%, so that means 30% upside from where we are. So right now the stock basically is expected to be 325, but right now it's only 250. So it's 30% upside from where we are. Sometimes this might be 1% or even 0 or whatever. That means basically that the company is where it's meant to be. Now, there are two things you can do. And like I've always said to you guys, whatever this number says, add another 5 to 10% depending on how volatile this stock is, for example, or how risky this stock is. If it's a very high risk, which basically Salesforce isn't right now. Salesforce is a very, very well established company. They have excellent free cash flow. They're not like one of those high beta companies, if you like. So having 5% for this in terms of margin of safety should be fine. 10% even better if you can do that. Now this gives you 30% upside from where we are right now, so that gives you enough cushion. For example, if it doesn't meet that sort of a basically price, if these guys were over basically pricing or whatever, then at least it gives you that cushion, you know what I mean? So that's important. But if it is 0 or 1% or whatever, or maybe just slightly on the high end, for example, if this was trading right now $327 per share, $2 over where it's meant to be, it's still sort of a fairly valued. But what you need to do then is add your margin of safety, then sit back and watch until it hits that price target and have the discipline to do it. Don't jump into it because I've said it, it's undervalued at this point in time. Always have your margin of safety. That's why if you join here, you will get the watch list is, and the watch list normally asks you whether you want 5% or 10% or 15%. Okay, and it's important. Companies that were like Salesforce back in the days, I had about 15% margin of safety, and the reason I did that is because the company was very high, high volatile stock. It was moving 5% this way, 6% that way. So you really need to be careful. But Salesforce is the first company that we're going to talk about today, and as you can see, it's a very profitable business. They have excellent free cash flow, and they expect it to grow nicely. But right now, it seems Mr. Market is not happy with this stock. And I'm going to use fast graph, but I'm only going to use it for the forecasting part, because otherwise the video is going to be long. So based on the normal, basically the estimates for moving forward, right now we're looking about basically you're losing about 12% if you bought the stock right now. But if you use the normal multiple, okay, and I don't want people to get confused between these, okay, these are two different platforms. I really like fast graph because it kind of shows you based on the earnings where you should be buying the stock when when it's overvalued and so on. So it kind of gives you extra information that you can take into consideration. It looks the 5-year average, whereas these guys are also using the free cash flow model. So they're using the discounted cash flow models which takes into consideration the future expected free cash flow of the company, and then they basically discount it back to the current whatever price and so on. So it's really important to understand the two. And now what we're doing here is just kind of giving you another option. I don't want this to confuse you, but if you use the 5-year multiple where this company has been trading over the last 5 years, which is what they call the normal multiple here, you would be making your 10,000 will become 23,500 basically US dollars. So you'll be making 134 basically percent on your money, which is absolutely amazing. So that's the first company. The second one that we're going to look at today is very similar to Salesforce, and that's ServiceNow. And as again, another one that's has upside of about 10%. Profitability is great. They've got excellent free cash flow, and they're expecting the earnings to grow nicely, which is very good. So if we go to fast graph now and just check. Again, do your own research, do a little bit more than what I'm doing here. Learn about the business and understand how do they make money, where does money come from, what countries are they in. Like, just look around and just learn the business inside out before you invest. If you bought it right now based on the estimates moving forward, so the earnings expectation, you'll be losing about 50% of your money. If you use the normal multiple, which is what the company has been trading, which is 84 PE, which is very, very high in my opinion, then you would be basically making about 120% on your money. So that's 22,000 US dollars of the 10,000 you invested initially. So be mindful and be careful, but at the same time, just do your own research. Another one that people think that is dead and gone completely is Adobe. I don't think Figma, actually, by the way, the company they were about to acquire for $20 billion, has now got market cap of over $100 billion, I think, because it traded massive, like within 2 days it was up so much. I can't even remember, I can't keep up with it. Figma was a company that they wanted to buy, and basically the regulators initially stopped it, but they were in the process of buying it, and now it's a publicly traded company, almost as big as Adobe in terms of market cap. But let's see if they can compete with them. I like companies that have a bit of a competition, and this one seems to be right now struggling to figure out what the best way forward is for the company. I think management is doing a great job. AI is, of course, is going to change a lot of the things that they do. There's a lot of uncertainty about the company side, business side of things, but I don't think this will affect the company in the long run in terms of revenue side of things. I think the company will still be profitable. But they might lose some of the market share to their competitors. Yes, they have a wine mode, and they have a kind of sticky business, because like I've always said to you guys, we do use a lot of their products, and without even thinking about it, within every single year we just basically renew it. We don't really think about it. Why? Because we're used to it, right? We don't want to change. I don't think basically people that I work with would be happy if we say, oh, you know what, we're going to change it to Figma now all of a sudden. Maybe they will be happy with it, but I don't know. But overall, the company seems undervalued at this point in time. Even if you look at the estimates moving forward, which is that 12%, 30, 11%, and so on, you will still be making about 11% in basically in the next 3 years, which is next 2 years, which is very good. Okay, 11% on your money, and then top of that, if you use the normal multiple, which is that it basically 38 PE, if you like 38 multiple, you'll be making 182% on your money right now. You will have about $28,000 in basically 2 years time, if basically that comes, if the company does the same thing, which I don't think that will be the case. I don't think the company will have that higher multiples moving forward, but at the same time, if you use the normal estimate, that's more realistic. You'll still be making about over 11% on your money, which is nice to see. The next one that we're going to look at today is the analog devices. Okay, there's a few semiconductors basically companies in this one. This one is 102 billion market cap, and as you can see, about 11% upside from where we are. Profitability is okay, it's not the best. Okay, they've got $3.2 billion of free cash flow right now. They expected the earnings to grow nicely, which is really good. EPS and revenue are expected to grow nicely, about 11% upside from where we are. So if we go into fast graph and type IDI, okay, and we're just using the estimates again. If you bought this stock right now, basically, in fact, I want to show you something. Let me just go back here. This is what I mean when we talk. Look at how cyclical this business is. Some years are up, some years are down. So a lot of the semiconductors go through that orange line. Can you see is going up and down? So that's quite normal for this company. So when you're buying companies like Qualcomm and so on, take that into consideration. And don't just think, okay, I'm going to make a lot of money this year, because it could be a down year and then you have to hold it for at least a couple of years to get your money back or so on. But yeah, so looking at this one here, it looks like based on the normal multiples, which is about 18, and for the next couple of years, by 2027, you will lose about basically about 1,200 of your money. If you use the normal multiple, which is that 21 PE, which is not bad at all, you'll be making about 7% upside from where we are. So again, another one that seems undervalued at this point in time. Fortinet is another one, like I said earlier, it is reporting this week, so it'll be interesting to see. But they are about 11% upside from where we are. $108 per share is where they think that they should be. Now, we're going to look at fast graph again to see what the company basically is expected to do. Based on the the estimates right now, we're looking about 50% downside. So like you will lose about £5,000 or dollars of your money. If you use the normal multiple, which is that 42 PE right now, and you will be making about 39% of your money, which basically works out about $13,888 per share on your total money, and that you've invested initially 10,000, and you're now making closer to $4,000 on top of that. So that's the 5 companies. Again, do your research. Don't just rely on the information that I'm giving you here, because yes, I can give you all of this information, but you need to do your own research to know exactly like what you own and why you own and so on. So yeah, just do a little bit more research. And then with regards to Sharia-compliant side of things, I use Zoya. I have no affiliation with them. I've been a subscriber for quite some time. to their platform, and I like how simple it is. I use it all the time, so I've got a few questions about people asking me which one I use. I just use them. I don't have anything to do with them, but yeah, that's the Sharia compliance side of things. If you have any questions, let me know on the comment section. But these are the companies I wanted to share with you guys. They are really great companies, but don't trust me on what I'm just saying. Like, don't take for my word for it. Just go away, do your research. I do own Salesforce, I do own Adobe and Fortinet. These are the three that I own. If you are on the family, if you are on the Patreon account, you will see the family in the family portfolio. I own two of these companies. I'm posting again today the family, the portfolio updates, inshallah, today. So you will see exactly how much shares of these companies I own and so on. Anyway, I'm going to stop the video here. If you join us in here and on the Patreon, that would be really massive help for the channel. Have a wonderful day. Assalamu Alaikum.